This is David Roach. We're talking about Omicron, quantum economics, and independent strategy. Now, Omicron is the new variant of COVID. It was previously called B.1.1.529 and has been renamed Omicron according to the Greek names and terminology that is used by the WHO. Omicron really broke out only about a week ago. There are about, as of last Wednesday, about 1,200 cases in South Africa, basically in the Gauteng area, which includes Pretoria and Johannesburg. But the first time it broke out, it was in Botswana. That's the first case. Now it's all over the place. It's in Hong Kong, it's in the European Union, in Germany, Holland, Belgium, it's in Switzerland, it's in the UK, it's in Israel, Egypt, Turkey, and of course, multiple African states, including places like Eswatini and Malawi. The thing that is worrying people about this particular mutation is that it appears to spread faster and it may evade vaccines. These are the 2 points. Now, let's reason about that for a minute in my amateurish, non-virologist sort of way. This particular variant, so Omicron, O-M-I-C-R-O-N, by the way, has 30 mutations approximately. Now, about 10 of those mutations are to the spikes, which enable the virus to bore into our proteins and stay mobile, moving around our bodies. They're like electric drills, really. It just means it anchors the virus and makes it more potent within our system. The other mutations are to the spikes, which trigger our immune system and triggers the vaccines we have taken to boost our immunity. Those spikes have changed. If they have changed in a way that the vaccines can't recognize them or our immune system can't recognize them, then this variant of COVID becomes much more deadly, probably, and certainly more infectious. Now, let us step back a minute from Omicron and consider where we were in terms of COVID before this new variant emerged. Here are some key facts. The Delta Plus and Super Delta Plus global daily infection rate is currently about 700,000 cases a day. At the beginning of October, that figure was 300,000 or 400,000. So, to all intents and purposes, it is doubled. The locus of this new outbreak is Europe. At the beginning of October, cases were about 100,000 a day. Now they're 200,000 a day. The US basically flat, but turning upwards. And developing economies are reporting extremely low cases and very low vaccination rates, the two of which do not go together and will not last if they even represent reality. I'll just give you 2 examples. South Africa has got a vaccination rate of 24%, and until Omicron came along, it was reporting 500 cases a day. If you take India, it has a vaccination rate, and I'm talking about fully vaccinated people as a percentage of total population. India is 29%, and is reporting cases of approximately 10% of one European country. So in other words, these emerging markets are reporting extremely low cases, but at very low vaccination rates. So South Africa, 500, and India, 10% of the UK. But that compares to, say, 30 to 40,000 a day in the UK, and 60,000 a day, which is the peak for last week in Germany. So of 2 things, either the figures are wrong or they're going to be wrong. Because if the percentage of the population has not developed some mysterious form of herd immunity, which developed countries have not, then clearly those levels of vaccination, those levels of infections do not go together. Now, I want to come to what has really changed. What has really changed is the overall pandemic has now become what I call a permademic, which means it is not going away. It moves from one part of the world to another part of the world. It moves in waves. Emerging countries or developing countries or poor countries with very low vaccination rates serve as a sort of human laboratory where it develops new variants. Those variants spread extremely rapidly. Viruses don't need any passports. So what breaks out in South Africa this week will crop up in Amsterdam next week. And that will go on being the case. Why is that so? Well, the key to understanding that is what I call the vulnerability index of both developing markets, developed economies and developing economies. And the vulnerability index is really a combination of a number of factors that determine what percentage of the population is at risk from COVID infections, present and future. Well, first of all, one has to consider the anti-vaccine lobby, which won't accept a vaccine under any circumstances. And they are between 12 and 25% of local populations in most developed economies. They are a risk to themselves because they can get COVID, and they're a risk to other people because they can spread it. Then there is the declining efficacy of old vaccinations. If 6 months ago you immunized 100 people to say 95, 98% with a good vaccination, that was 6 months ago. Today, probably 30 to 40 of those people are at risk from COVID instead of 4 to 5. So as time goes on, vaccines get less effective. And the result of that is it adds to the pool of people who are at risk from COVID. Then there are, of course, the phenomena of inferior vaccines. There are many big countries, which I won't mention, which make vaccines which there really have been no domestic scientific assessment of, and they have not been peer reviewed. When they have been reviewed in third countries, the immunity conferred by these vaccines is around 60%, often on the wrong side of 60%. So as these vaccines are often given to countries, poorer countries, as vaccine diplomacy to increase the power of the donor, and they are widely used there, this means that those countries which already have a low vaccination rate, say at best 24 to 30%, approximately 40% of that percentage. So talking about say 6% to 15% of the people who actually have been vaccinated are still at risk because the vaccine with which they have been vaccinated only confers, say, 60% immunity. That adds to the stock of people who can also be infected by new strains, new variants, and old variants of COVID. And then there is the fact that vaccinations are rising rather slowly. The total vaccinations are increasing by about 200,000 a week. But we still have over 40% of the world population of 7.7 billion who are not fully vaccinated. And we have 20 to 30% of the people in developed countries who are not fully vaccinated. So again, that adds to the pool because the rate at which old vaccines are becoming less effective outpaces the rate at which either booster shots, which cover about 8% so far of high-income economy populations and about 4% of upper middle income economy populations, that is not enough to offset the decline in old vaccines and the other factors that we've discussed about. So actually the pool of people who are vulnerable to COVID is increasing faster than the vaccination rates are immunizing new people. Now, what about the economic consequences? Well, if I was doing this video a month ago, people didn't care. They said, well, you know, the Google activity indices are up, people are out shopping, they're on the beach. Well, maybe it was a little late in the season to be on the beach. If those people don't care, why should we as investors care? And markets sailed on ad infinitum, fueled by central bank generosity, government funding and spending, and the fact that people were really happy to be out of lockdown. Of course, the same fact that they were out of lockdown meant that they were getting infected and getting ready for the northern winter when they all huddled together in close spaces. And of course, what is the result? The result is if you remove social measures, plus you're increasing the pool of people who can be infected by the vaccine, surprise, surprise, we get new waves of infection. And now we have a new variant, which seems to be able to infect people a lot faster than the existing variants. So the big issue is that markets are now waking up. It is dawning upon them the reality that this is a permademic, not a pandemic. It moves in waves. It will be bad in Europe now. It will probably be bad in the US next. It will probably go to the emerging markets afterwards, and it will go round and round the world in waves, cropping up in different places at different times. But the key factor is it does not go away. Now, there are two consequences. One is relatively short-term, meaning 1 year at least, and the other is a much longer-term issue. The shorter-term one is supply and demand disruption. The longer-term one is deglobalization. Let us deal with both in turn. The odd thing about waves of the pandemic, the odd thing about supply and demand disruptions which result, is that they are both pro-inflation and anti-growth at the same time. They are pro-inflation because it disrupts the way of producing things. It disrupts production. It disrupts how raw materials flow to get that production going. And then it disrupts how goods are distributed and finally reach the consumer or the corporation that is investing the final good. So the first thing is that costs go up. The second thing is that demand goes down. One of the reasons demand goes down is, of course, because of availability. The goods simply are not there. Therefore, demand falls. It is also because, of course, consumer confidence gets hit, and investment confidence will ultimately get hit by the fact that the world is not normalized. You do not go back to where you were before the supply chain disruptions actually happened. Now, this raises a very interesting question because central banks are caught in a dilemma. They are, certainly in Anglo-Saxon countries, way behind the curve in fighting inflation. This kind of transitory argument, a word used until it all but used its meaning, was perhaps the greatest verbal source of inflation that I've seen in the English language for quite a while. But behind that was happening real inflation, and it was pretty durable inflation. So they're behind the curve in fighting that. But now they've got a double problem because there's going to be lower growth at the same time as we're going to get higher inflation. So which objective do they choose? Their employment growth objective or their inflation objective? They are, to say the least, conflicted. If they choose to go for growth, that means printing more money, buying more bonds from the government, giving the government more money to hand out to people who are either the victims of inequality or risks stopping consuming for any other reason, because there is a supply chain disruption, which impacts demand at exactly the same time as it impacts supply. If they choose the growth objective over the inflation objective, then the world has changed because the bond vigilantes are now, they're in the field, the global economic field, and they will punish central banks which do not fulfill their inflation objectives or prioritize employment and growth over inflation objectives. They will punish them with much higher long-term rates and weaker currencies, which will cause further economic dislocation. That is where we stand. Now let us turn to the longer-term effect. The longer-term effect of all of this is to make global supply chains look riskier and more fragile. So what do people do about that? Well, the answer is that corporations bring home the production. In other words, onshoring or nearshoring rather than globalization. So globalization is the big casualty. And it will go on for years. When you onshore or nearshore production, you onshore and nearshore the services that go with it. If you're not shipping goods from China, you no longer need the logistic expertise of being able to do so. You maybe ship them from Mexico or from Milwaukee, but it's a completely different sort of service industry that goes together with the deglobalization of the global economy. It is not just manufactured goods and raw materials. So the movement onshore or nearshore is essentially dictated by security. It is in order to make the supply chains secure, so that a ship going kind of sideways across the Suez Canal, or an epidemic in China, or a geopolitical effort to stop Taiwan making semiconductors for the US market, all of these things go out of the equation for your corporation. But what comes in is the higher cost of producing the goods in this deglobalized way, onshore or nearshore. And the reason it is higher cost is because globalization would not have existed if it was not cheaper. So the fact that it is going backwards in the name of security actually means that corporations are accepting a higher cost, which they will pass on to consumers and be able to, because many of these great global corporations have a very dominant market position. So it will pass on these higher costs, which actually means that if this is done on an incremental basis, in other words, year after year, you are living not just with a step change in inflation, but with a progressively greater inflation rate in successive years. That would be my humble forecast. So there we have it. Disease equals supply chain disruption. Supply chain disruption impacts near-term output and inflation at the same time. So supply and demand at the same time. And then you move on to the longer term impacts of deglobalization. And these are the major economic messages, together with the consequences, which are lower productivity, lower growth, and higher inflation, conflicted central banks, and very high levels of debt, which prevent central banks really pricing capital for risk, because if they did, the risk would bring down the mountains of debt which have been created by governments during this pandemic and before. What do you do about it? Well, you don't own bonds. That's clearly, equity and bond markets will actually both be weak, because the higher interest rates, long-term interest rates, which I see, will increase the equity discount factor, which will impact equities which have low yields, low dividend yields, and particularly if those dividend yields are sometime way out in the unpredictable future. So people will opt to get their money back more quickly, not with the average duration of the equity market at the moment, which is 30 years, which means you don't get your money back. What you pay to buy the market today, you don't get it back for another 30 years, about which, frankly, I will say modestly, neither you nor I know a lot. But when the cost of making that bet, and it is a bet, goes up in terms of interest rates, then the value of those sort of shares falls, and people go back to owning, a higher yield stock with a visible business plan that can be comprehended by ordinary mortals, and with where the value of the stock can be actually seen to make some sense using a standard dividend discount model on a handheld calculator. Fine. Of course, you have to remember, if these disruptions really cause the global economy to go belly up, then even the best thought business plan does not hold up. Somebody once said to me, who was a president of a very substantial non-US bank, he said to me, well, David, you have to remember that if the global economy ever shrank by 8%, there would not be a single bank in the world, good or bad quality, which would not be insolvent. So it's always wise to remember that good business plans are all good as long as the world is relatively good. What else would you buy and own? Well, I think that the ongoing vilification of currencies by central banks will continue, and therefore people will continue to buy crypto assets. The cryptocurrencies such as Ethereum are probably better thought out than cryptocurrencies like Bitcoin. And I'm not saying I would make a recommendation to pile into Bitcoin, pile into Ethereum at these levels. What I'm making the argument is that if you don't trust governments, if you don't trust central banks, then you're going to look for an alternative anonymous source, store of wealth. And that will continue to be crypto assets. So that's one on the plus list. Also, agricultural commodities. We've done such a good job of wrecking the climate and the planet that I think agricultural commodities will continue to be in short supply, and prices will be very buoyant, to the detriment of the poorer people who cannot then afford the food. And finally, renewable energy metals. Those are the metals that go into making your electric vehicle car battery. They're the metals that go into making windmills make electricity. Those sort of metals, which are, to name but three, copper, lithium, and cobalt, will do pretty well in this climate, because according to the calculations that we have done, the amount needed, even for relatively conservative forecasts of renewable energy and electric vehicles, the amount needed will mean that their value will, in total traded exports, global exports, their value will surpass that of oil within 10 years. And then finally, of course, I come to the fact, if you are going to fight disease, then you're going to have to fight it with healthcare companies. And although they may charge rather a lot for the privilege of doing so, they're still going to make money for their investors, provided you choose the right healthcare companies. Right. Thank you for watching this video about the latest version of COVID, Omicron. If you like it, please press like below and subscribe to the channel. And meanwhile, please, good night, sleep tight, and don't turn off the lights, because at the moment they look like turning themselves off in due course. Bye-bye.